Welcome to another webinar presentation on trading strategies offered on TraderPlanet.com. Strategies frequently deal with catching the longer-term trends, but in this case we are going to be looking at short-term trading strategies that focus on using the predicted highs and lows that are indicated on Vantage Point intermarket analysis software. First, we do need to make a little disclaimer. This is an independent review. It is not endorsed by Trader Planet. It is not a situation where we recommend anything or endorse anything, but we're simply presenting a concept. Further, I do want to say that what I am presenting is more of a concept than a strategy. I have not back tested it, so I can't give you a track record, but I will show you some examples of how it works. As with any analysis, I usually like to start with the big picture. In this case, I have put up a one-year Vantage Point chart of the Euro FX futures, which was the contract that we will be using to analyze. And as you can see, over the longer haul, the Euro has trended to the downside, but at the right edge of the chart, the current time is approaching some points that should be of interest to us. These circled areas are previous highs. What we know when the market approaches a previous high is that this is possibly a battleground where something will be decided. Something will happen to make the market break through that point, which in case that would be a bullish situation, or something will provide enough resistance to turn the market back down. What we do know is that there will be some activity at this point. The other situations that we have going on here, if you look back at the previous high at 160, previous low at 124, 123, and you look at our current price structure, a 50% retracement of that whole down move would give you 142 as a potential target, and that is about where the market is at and on this chart. As you know, a 50% retracement is a pretty strong indication of some resistance, or if it escapes this resistance, of strong support. It worked previously. You can see here in the previous example where we had the rally to like 146, 147 to the low of 125. 50% retracement of that shorter move was 136, and that's about where the market turned back down. So retracements are one of the things that I do look at, and I do look at the longer term move just to get my whole picture straight as to what kind of influences I can expect on the euro. Now we want to turn a little bit to a shorter term chart so we can actually get a better picture of what we're talking about. I will use several different indicators from Vantage Point, and these are essentially background indicators where I want to find out kind of what the tone of the market is. We're going to talk about the intraday stuff later, but first of all, number one, I like to see the blue line. That's the predicted medium-term moving average. If it's going to be a long position, I want it to have crossed the actual medium-term moving average, which is a black line, and have it be pointing upwards as it is in this case. Secondly, if you look on the far upper right there, you'll see that we have an extended move up. I like to see the market having made a move because you know it never moves in one direction forever, but tends to have corrections, and so I like to see a market that has already moved and expecting a correction. Secondly, about that point is that I like to see a candle that gives me an idea that this is about ready to turn. In this case, we have the black bearish candle coming at the top of this move. Black, as you know, in the candlestick analysis is a bearish situation. White is bullish. So in this case, we have number two indicating that this could be a potential bearish situation because we're at a top and we have a black bearish candle. Three, I like to look at the predicted neural index from Vantage Point, a proprietary indicator that they have that compares moving averages. That's the gray line down at the bottom. If it's at 1.00, it's bullish. If it's at 0, it's bearish. So you want to make sure that that indicator also lines up with the others. The predicted differences, first on 4 is the middle term moving average difference. Number 5 is the predicted long-term difference. those also should be in alignment with the blue line above, so you can see that the direction is similar. They indicate the strength of the move and whether the move is likely to continue based upon what has happened in the most recent bars. Now we'll take some of those things out so we can get a little bit clearer picture, but this is the overview of what you have when you have the predicted high and the predicted low. The predicted next day high is that gold line that you see goes across the top. The predicted next day low is that pink or fuchsia line, I guess would be the color you would call it, along the bottoms. Those are the signals, the indicators that we will be using from vantage point. Keep in mind, we are not going to forget about those background ones, but we want to make sure that we're looking at the predicted highs and lows when we make our decisions for this strategy. We're also going to narrow down the time frame a little bit to give you a little bit better picture, so we'll cut this back to approximately 8 or 9 days or so, just those days within that red square that you see. And here we have those squares. Now, if you look over at the candlestick on the far left, first one, you'll see that the blue line is above the black line, or the predicted moving average is above the actual moving average, and it is pointed up. Secondly, you will see that the predicted, the candle rather, is white, and that would suggest that this might be a bullish situation where the market in this particular day opened kind of towards the bottom and then moved up during the day. So that's one bullish indication. Number 3, the predicted Neuro Index is at 1.00, so that's bullish. Number 4 and number 5 are a bit of a problem on that first bar because they are either flat or sideways, so there's not a whole lot of indication you can get from those. Usually when you look at those signals, you want to say, okay, I want the preponderance of them to be going in the direction that I want to make the trade. Secondly, you also want to be sure that you kind of have a sense of the whole market. You need to know, for example, is there going to be a major report coming out that will affect this market? Are there seasonal factors? Are there other things that are going to happen that potentially could make a difference in this market? Now, based on the evidence that I see here, I would like to be long this market, the euro, on the next day after this bar that I've highlighted here. The essence of the strategy is to use the predicted next day high, which in this case happens to be 140.40, and to buy at 20 points above that point, which would be 140.60. I will buy 3 contracts there because, as I said, the indicators are in alignment that this appears to be a fairly significant or strong move. I will take a profit 100 points, 200 points, and 300 points above the entry point. A little confusing, but it'll kind of make itself clear, I think. Our first opportunity will be right here, as I mentioned, at 140.60, where we will buy, we'll be long, and then we'll be looking to take a profit each 100 points up. I'll show you those as we move along. I will be using the predicted next day low, this pink or fuchsia line here, as a place to put my stops or eventually to reverse the position. Here's what it looks like. As I said, we are going to buy 3 contracts right here, 140.60. I'm going to take a profit of 100 points if it gets to 140.160, which it happens to do on the very first day here. So I've got 100 points in the bank. Then I'm going to take profits if it goes up another 100 points. That happens, misses this day, but it happens on the third day out here. So now I have 200 points profit on this particular contract. So I can put that in the bank and take that and go home. My third target, 143.60. When I don't reach that point, then I start to wonder, or not wonder, I guess. I already have my stop in place. I know where it's going to be because it's going to be 20 points below the predicted next day low, which in this case is right here. As you can see, it will get you out at 141.71. And you will then have a situation where you are out of the market, out of all 3 contracts, and you have made a profit without taking any major losses or without risking a whole lot. Now, this is not a guaranteed success story every time, but this is a process that you can use to look at your market. Now, here's the position at which you would be stopped out. then you have a choice. You can perhaps stop and reverse. Here's your signal basically to go short. I am not a big fan of stopping and reverse because it seems like you almost need to have a little time to catch your breath and get used to going in the opposite direction. So in my case, I probably would just take my let my three contracts take care of those, and not attempt to get into a new order or a new position until I have another signal. But it's up to you. You might want to do that. Everything is in line, as I mentioned before, to take that signal, because you do have the medium-term moving average is starting to die down here and roll over. This one's starting to point down. This one, the differences are pointing down. The predicted neural index is at 0. So things are lined up. It's a choice you would have to make, and that's, I guess, where you make the big bucks if you make the right decision. Now let's just summarize a little bit where we're at this point. We said we had the predicted high, 140.40, which was this yellow gold line right here. We're going to be buying at 140.60, which is this point right here. We have our profit target 1, we have our profit target 2, we have our profit target 3, which we did not make. So we had a predicted low over here, as I said, and we had a stop point of 141.71 at which we would get out. So when you add up everything on those three trades, the first trade had 100 points, the second trade had, or contract, I don't really want to call them separate trades because it's kind of all one basic trading position. The first target is 100 points, the second one has 200 points, and the third one you came out of there with 111 points. You didn't get your full amount, but you still accumulated out of here 411 points on this long trade. Now on the downside, as I mentioned, I would probably wait for the next signal. In this case, on this bar, I did not get a signal because it did not go above the high or below the low sufficiently. It has to, remember, do 20 points. I don't have any compulsion to go either way, although based on the evidence, it looks like maybe this blue line is weakening and these things are pointing down. This line, the differences are pointing down. This is at 0. So it looks like a sell would be the logical thing to expect. So I would place a sell stop right below 20 points below the predicted next day low. In this case, when we're talking about a price that is almost the exact same as it was when we were talking about our previous point at which we bought. In this case, the predicted low was 140.77, and that would make our selling point 140.57. That would then make our profit targets down here 139.57, 138.57, 137.57. As you can see right here, it worked great the first day, the second day, pick up another one, the third day, it did not work. In that case, you're stopped out because the market then moved 20 points above the predicted next day high to stop you out. You already have one position you've already exited, two positions you've already exited, so this is your third exit, and you now have to make another decision that you could either reverse, stop and reverse. You have some signals going your way, except that in this case you have the blue line below the black line. The predicted medium-term moving average is below the predicted, or the actual medium-term moving average. You do have the predicted neural index that is at 1, which is bullish, but your predicted difference lines are still pointed down. So I would say the preponderance of evidence in this case is probably that you would not stop and reverse, but would wait again for another signal to come along on another candle. Now let's summarize the short trade results. As I mentioned, the predicted low that we had here, 140.77, and we now have a target, a sell point right here, rather, of 140.57. So there's our target number 1. We achieved that, 100 points in the bank. Here's target number 2, 200 points in the bank. We did not achieve target number 3. But in the case of the target number 3, you can see that the predicted high that day was way up here, and it was 140.27, and so that makes our buy stop point 20 points above that at 140.47. So the trade, in after all this, it has netted just 10 points. But as you know from any trading experience, any win is better than a loss. And so when you accumulate these three trades, you have 310 points total on the short trade results. You put those two together, the summary of those trades, 411 points on the long side, 310 points on the short side, 721 points in 8 trading days. Not too bad for a little over a week's worth. Thank you for attending this webinar. Be sure to go to some of the other webinars that we have on this site and see more about instructions that you can get on learning how to trade better, both short-term and long-term.